Good morning and welcome to the Morning Bell. I'm Robert, joined as always by Lizzie and Steve. It's Wednesday, August the 19th, 2026, and we have a packed show. Markets are navigating a semiconductor-led sell-off, rising bond yields, and a historically tricky seasonal window, while Lowe's and TJX are reporting earnings this morning, and the Fed's July minutes drop later today. Let's get straight into it. Lizzie, futures are pointing lower, the 10-year is pressing toward 4.75%, energy costs are firming, and technical strategists are flagging a historically dangerous seasonal window. How are you framing today's setup heading into the open?
Morning, Robert. The setup is genuinely cautious. You've got multiple headwinds converging at once, with rising bond yields squeezing valuations, energy costs adding inflationary pressure, and a semiconductor-led sell-off dragging on the Nasdaq after SanDisk, Micron, and Credo all got hit hard in the prior session. The SPY technical picture backs that caution. The bias right now is neutral, sitting at 7-67, with some underlying momentum present, but no clear breakout trigger in either direction. So traders are firmly in wait-and-see mode ahead of today's Fed minutes.
BTIIG's Jonathan Krinsky is warning that midterm year seasonal patterns since 1990 show average losses of around 6% for the equal-weight S&P 500 between mid-August and mid-October. And he's noting we haven't had a single high-volume down day on the NYSE all year. How seriously should traders be taking that warning?
Very seriously, and the absence of any high-volume down day is the detail I keep coming back to. It means markets are entering this seasonally weak stretch with essentially zero defensive cushion, and the VIX near yearly lows confirms that nobody is positioned defensively heading into it. The equal-weight S&P 500 is up about 15% on the year, which is a significant amount of profit to protect heading into a window that has historically averaged losses of 5% on the broad index, on the Nasdaq, and 8% on the Russell 2000. So Krinsky's recommendation to reduce risk or add hedges is a measured and reasonable one given where we sit right now.
On the semiconductor pane specifically, SanDisk, Micron and Credo all getting hammered, and South Korea's Kospi triggering a circuit breaker overnight. Is this sector rotation or something more systemic?
The core issue is that debt concerns tied to AI infrastructure spending are becoming impossible to ignore. There's a real question forming about whether the capital being deployed across the hyperscalers will generate adequate returns, and that's hitting the names most exposed to that narrative hardest. The sector is still up nearly 47% over 6 months, so there's significant profit on the table. But the differentiation within chips matters enormously right now. Western Digital looks solid with nearly 49% sales growth expected and meaningful margin expansion. Nova stands out with consistent double-digit revenue and EPS growth at a 33.8 times forward PE, while Texas Instruments is the one to avoid given slowing revenue, meaningful margin compression, and EPS contraction over 5 years. It's less about broad rotation and more about separating structural winners from beneficiaries of the initial hype cycle.
NVIDIA reports August 26th. It's the one Magnificent Seven name actually outperforming this year at plus 18%, while Meta is down 17% and Tesla is down 25%. How much pressure is on that print to hold the AI trade together?
Enormous pressure, and that's not an overstatement, with real questions emerging about whether the combined $700+ billion in AI capex across the hyperscalers is going to pay off. NVIDIA has become the single pillar holding the AI narrative together for the broader market. The S&P 500's CAPE ratio sits at 42.35, and most Magnificent Seven stocks are trading at even higher valuations relative to earnings. So any disappointment from NVIDIA on August 26th carries meaningful repricing risk across that entire cluster. And the Phase 2 thesis, rotating into industrial and infrastructure beneficiaries of AI rather than the original Mag 7 names, is gaining real traction through energy and semiconductor equipment as that uncertainty builds.
On today's earnings specifically, Lowe's and TJX both reporting this morning with Walmart and Deere on deck tomorrow. What are you watching as a read on the consumer?
TJX is the one I'm more focused on because last quarter they beat by 18%. And the question today is whether that off-price consumer trade remains durable as energy costs rise and yields stay elevated. Consensus is looking for EPS around $1.19 on $15.2 billion in revenue. So any weakness there signals the value-seeking consumer is starting to feel a real pinch. Lowe's only beat by about 2% last quarter, and estimates are calling for $4.24 EPS on $26.2 billion in revenue. And given that higher mortgage rates have effectively locked existing homeowners in place, the key read-through is whether repair and remodel spending is picking up the slack from stalled new home transactions. Walmart tomorrow at $0.74 EPS consensus on nearly $187 billion in revenue will be the broadest consumer health check of the week, and that one has implications for the entire staples sector.
Steve, let's bring you in. Yesterday's housing starts came in at 1.239 million against a 1.35 million forecast and a prior reading of 1.415 million. That is a significant miss. How does that data point fit into the broader macro picture given where yields are?
That housing starts number is a meaningful signal, Robert, because it tells you that elevated mortgage rates, driven directly by where the 10-year Treasury is currently sitting near 4.7%, are continuing to suppress new residential construction at a pace well below what the market expected, and the miss of roughly 111,000 units versus forecast, combined with a sharp step down from the 1.415 million prior. Reading confirms that rate-sensitive sectors like real estate are absorbing real damage from this yield environment. It's worth noting that this softness in housing, alongside weak industrial production data released around the same time, is actually part of what caused yields to pull back slightly from their recent highs, though they remain stubbornly elevated heading into today's session, and the Fed minutes this afternoon will be closely watched for any shift in the policy tone.
And what are you watching for the rest of the week on the economic front?
The key release tomorrow morning is initial jobless claims, where the forecast is sitting at 210,000 against last week's actual of 209,000, which itself came in above the 202,000 estimate, so there is a mild but consistent drift higher in claims that deserves careful attention. If we see claims push meaningfully above 215,000 tomorrow, that would strengthen the case for the Fed to hold rates in September, and with 94 out of 104 economists surveyed by Reuters already expecting a hold, a soft claims print would reinforce that consensus firmly, while a surprise drop back toward 200,000 would complicate the narrative and potentially add upward pressure to the long end of the yield curve at a time when markets are already dealing with plenty of rate-driven stress.
Lizzie, turning to crypto, Bitcoin is holding near $64,300, but the 30-year Treasury just hit 5.34%, its highest since 2007. BlackRock is sitting on roughly £746,500 BTC, and Tom Lee is doubling down on the long-term thesis. Does the macro pressure override institutional conviction right now?
In the near term, macro is winning. The technical bias on Bitcoin is neutral this morning, with modest bullish momentum present but a slightly negative MACD keeping buyers from fully committing, and key resistance sits at $65,000 to $66,000 with support around $63,000 to $64,000. The BlackRock and Tom Lee conviction is a longer duration thesis about Bitcoin as a hedge against fiat debasement and rising fiscal deficits. And while whale accumulation of roughly $2.64 billion in BTC over 2 months is a notable signal of sustained institutional demand, that doesn't prevent short-term macro-driven pressure, especially with today's FOMC minutes adding another layer of uncertainty to the session.
What about Ethereum and Solana? Any meaningful differentiation worth flagging?
Ethereum is actually the more interesting technical setup right now. It's showing a lean bullish bias around $1,993, with a fresh MACD bullish crossover as the primary signal driving that, though price is pressing against the upper Bollinger Band, so there is potential resistance to respect before chasing the move. The Glamsterdam upgrade expected in Q4 is a notable catalyst on the horizon, with analysts targeting $5,000 to $5,400 in the next bullish phase, and $2,000 being the key psychological level to reclaim first. Solana is the contrast. It's flashing lean bearish around 77.46 tons, sitting right at the upper Bollinger Band, which has historically acted as resistance, leaving the setup vulnerable to a pullback. And traders should be cautious about committing aggressively to the long side there. The Neuberger tokenized high-yield fund launching across Ethereum and Solana is a notable structural development for both chains, regardless of where short-term prices settle.
That wraps up today's Morning Bell. This is not investment advice. Do your own research before making any financial decisions. And don't forget to subscribe so you never miss a morning. See you tomorrow.